We've all heard about investing, and you may have even overheard a conversation about stocks, bonds, and mutual funds. Yet most of us own a pet rather than a comprehensive financial plan, and very few are confident in their financial knowledge. So, before we delve into the details, let's start from the beginning. Having a savings account isn't enough. Saving money is important, but it's only part of the story. For people who are unsure about investing, cash can provide orderly and routine returns that feel safe and predictable. But there can be some downsides if they make up the majority or entirety of your long-term investment mix. Smart savers start by building sufficient emergency savings within a savings account or through investment in a money market account. However, after building 3 to 6 months of easy-to-access savings, investing in the financial markets offers many potential advantages. Let's harness the power of investing. The goal of investing is to grow your money over time. Although investing has inherent risk, it also has the potential for greater returns than if you simply left your money in a bank account. To understand, let's go with an example. Meet Zahir, who just graduated from college and got his first job in a corporate company. After a month of his hard work, has just received his first paycheck. He's very excited. On his salary credit, he had to pay rent and utilities, which contribute 50%, which is the needs, and 30% towards food and entertainment activities, which are the wants. The remaining 20%, he wants to do something with it, maybe even invest it, but isn't sure where to start. So Zahir decides to deposit it into a bank savings account. He thinks it is a safe plan, as many do so. After all, the bank will actually pay him a small amount of money each quarter or year, called interest, just to keep his money at the bank. This sounds great. He put away 30,000 rupees per year, that is 2,500 rupees every month, into a bank savings account. While the interest rate was relatively low at around 5%, his funds were safe and easily accessible. At the end of 20 years, his funds grew to approximately rupees 10 lakhs plus. Suppose Zahir acted as an investor and set aside rupees 30,000 per year. That is 2,500 rupees every month. Consider that he had invested his funds into a moderate portfolio, which yields 10% per annum over 20 years. At the end of 20 years, his funds grew to nearly 19 lakh rupees. So why is investing important? Investing is an effective way to put your money to work and potentially build wealth. An individual's goals depend on a host of factors that may include age, income, and risk profiles. Age can be further subdivided into the following 3 categories: young and starting in a career, middle-aged and family building, retirement age, and self-directed. These segments often miss their marks at the appropriate age, with middle-aged folks considering investments for the first time or the elderly forced to budget, employing the discipline they lacked as young adults. Smart investing may allow your money to outpace inflation and increase in value. The greater growth potential of investing is primarily due to the power of compounding and the risk-return trade-off. So let's visualize all of these to conclude the power of investing. Investing isn't just about how much money you have to invest. It's also about how much time you have to invest in it. That's because of the power of compound growth. Compound interest makes your money grow faster because interest is calculated on the accumulated interest over time as well as on your original principal. Compounding can create a snowball effect as the original investments plus the income earned from those investments grow together. In our previous examples, if investor Zahir keeps investing rupees 30,000 every year or 2,500 rupees per month for 40 years with an average annual return of 10%, watch how his balance skyrockets over time. So at the end of 40 years, his portfolio is worth 1 crore rupees, even though the actual principal he invested was only 12 lakhs. Every year, his 10% return was based on a newer, larger balance comprising his initial investment, subsequent yearly investments, and the money he earned from interest. That's the power of compound returns. Next, don't forget inflation. Inflation is something that everyone has experienced, particularly in recent years. This is another big factor to consider when comparing savings to investing. Recent savings rates haven't kept up with the rate of inflation, meaning the actual purchasing power of money in a savings account can shrink over time. This chart illustrates the impact of inflation on the purchasing power of a fixed annual income of rupees 1 lakh. Here, we see that with a hypothetical 5% inflation rate per annum, the fixed yearly 1 lakh rupee income can purchase only 72,000 rupees worth of goods or services at the end of 5 years. That is a 38% loss of purchasing power, and only 37,000 rupees worth of goods or services at the end of 10 years, which is a 63% loss of purchasing power. Graphically, you can see the negativity at the end of 15 years with the fixed 1 lakh rupees. Earning a rate of return higher than the rate of inflation can help ensure that you can continue to afford the things you want to buy. Finally, investing will grow your money more quickly. Yes, high-yield savings accounts and safe investments like money market funds sacrifice yield for stability. While your account value generally remains stable, it might not grow significantly over time. Historically, investing in short-term investments has been acceptable, but nowhere near as lucrative as investing in stocks or a mix of stocks, bonds, and cash. Diversifying away from cash has consistently resulted in stronger returns for investors, making it easier for them to achieve their financial goals. Look at the chart, which clearly depicts the investment diversification and its long-term potential to grow funds and build your wealth. Please also note that the past performance is no guarantee of future results. That's it for this episode. To put it short, investing is important to grow your money more quickly by utilizing the power of compounding, and also it will help to fight against inflation to maintain purchasing power. Investing may also provide you with a better shot at attaining your goals. Hope you liked the video. Please subscribe to our channel and newsletter to receive timeless advice on time. Thanks, and see you in the next video.